So to start things off, I think we all know what type of insurance policies we can sell, right? It's term life, and we understand this is the type of insurance that it's cheap in the beginning, super expensive later on, right?
Mm-hmm.
That's pretty straightforward. I've sold a couple term lives in the past. I think term life has its place. So what I'm not going to do is bash any insurance strategy that anyone is doing in here, right? To be super transparent. I'm going to be totally honest and just kind of share the different views of, how each of you can kind of implement this stuff. So term life, we know, cheap in the beginning, super expensive later on, no argument there. And we know with whole life, it's expensive in the beginning. And the little caveat is, if designed properly, can be zero cost later on. And that's what IBC will be able to provide, infinite banking. But for most traditional whole life policy, where 100% of the client's money goes towards premium, right? Base premium, no argument there, right? Straight up whole life. It's a set base premium, right? Doesn't change. Premium stays the same for life. And then there's a cash value component that builds over time, but takes many, 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 many years for it to actually build up and be, somewhat significant. So that we all know that's traditional whole life. It's expensive in the beginning and it stays the same. But obviously the advantage is I don't lose that death benefit. Unlike a term, it expires and then it basically catches up to what whole life would be, right? And then you've got the IUL, which is a mix, right, of whole life, and then has the investment feature, right, where you grow money in the index, right?
Right.
Okay. Now, what infinite banking does, this is an opinion. Everything I just said was factual. I don't think there's any argument there. So I'm about to give you an opinion. I believe what the infinite banking concept does is takes all of these products, term life, whole life, IUL, and takes the best out of all three into one. Okay? Now, the first thing we need to cover is policy design. How are you, the life insurance agent, designing policies when you talk to your clients? Most of us, the way I was taught in the beginning, even according to the state exam, you had that kind of qualifier, the multiplier with the person's income, the amount of assets, liabilities, and you kind of come together with a number and then what they can afford. Ultimately, you try to get them the most death benefit for the least amount of cost. That's kind of like how I was taught. Or you might have been taught buy term, invest the difference, right? Just get a cheap term life policy and then, invest in the stock market, right? And then you've got other individuals that are, 100% whole life or 100% term or 100% IUL. Me, on the other hand, I like to be super transparent, just bring them all. How do I get the best out of all three? So when it comes to policy design regarding the infinite banking concept, what this teaches is we simply tweak where are we putting the client's cash, right? So I can either have 100%. Let's say I'm dealing with let's do an example here, and I'll use me. Okay, I have a policy with Guardian Life Insurance Company of America, I believe is the full name. But I have a company with Guardian, and I am funding a policy on an annual basis of $70,000 a year. Okay, so this is my policy personally. Now, there's a couple of ways that I can design this, right? I can either have 100% of this 70 grand go towards base premium, right? Or I can split it up, right? So when we start talking infinite banking policy design, we're going to start getting into split designs. So me personally, I have a policy where I'm putting in exactly $7,000 towards my base premium or whole life expense. And then the other 63,000 is going toward PUA. You guys know this, paid up additions. This is a rider. This allows us to accelerate our cash value in the beginning years, right? Or even in the first year. So PUA, another word, cash value. Now, the $63,000 out of the 70, not only is it going to a PUA rider, but it's a PUA blend term. So some of that 63,000, a couple $100 in my case, because I'm only 24 and I was 22 when I started this policy, 22 going on 23. So part of that 63 is going to a term rider. So I'm taking the best of term, putting it in the beginning years of a whole life policy, right? And then I'm banking on a particular life insurance company. Personal opinion right here, I personally like to work with mutual life insurance companies, and I like to focus on actual performance when it comes to the dividend of any insurance company. All right, let me just type in too fast. Forgive me. So I like to focus on actual performance when it comes to the dividend of any life insurance company. And what that simply means is I'll try to find a real life insurance policy that has been in place for maybe 20 years, 30 years, to see what it actually performed throughout that particular time period. And then that helps me kind of choose the company I want to end up going with. So me personally, I have a policy with Mass Mutual, and then I have one with Guardian. So for today, we'll just go over my Guardian policy. This is the one I'm putting a big sum of cash, a lump sum of cash into per year. So this right here, 70K, 63 going towards PUA, right? Cash, and then with a term rider attached. Another word for this term is annual renewable term. And with this particular policy, I only have that term rider on for 7 years in the beginning. What this does is it allows me the ability to overfund my whole life policy in the beginning years without creating a MEC, which is super important. I would say another personal opinion here, number one goal when I work with my clients is to not create a MEC ever in the policy, no matter how long they own it, right? So with an IUL, this is something that IUL agents have to pay close attention to. If you're going to use an index universal life insurance policy, you have to pay very, 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 very close attention to the MEC limitations, the IRS limitations, because when you overfund an IUL policy, the chances of that blowing up in the client's face when they're 70 years old, 80 years old, increases significantly because of the dividend fluctuation, right? The performance of these IUL policies. You can do really, really well one year or really bad, the next year, and it ends up averaging according to the illustration that you guys write. You'll show an illustrated 7% return or 6% return. But if it doesn't actually do that over the course of X amount of years and you're ended up, with maybe like a 4 or 3 net internal rate, the cash value could exceed the death benefit. That's when we become a mech, and that's, not fun. So for me personally, number one goal when I work with my clients, do not create a mech. And the way I avoid creating a mech is by simply, we can run a mech test with guarantees, right? You go off the guaranteed values, not the illustrated dividends of an insurance company, because we all know that dividends do fluctuate with whole life products and IUL products. So if you go off the guarantees, you're able to kind of provide that sense of security, that peace of mind when you're running these more complex type of policies. People are putting in a lot of money into these things. As you can see myself, I'm only 24 years old. I'm dumping in 70 grand into this thing. So either I'm crazy in the head to be dumping 70 grand into a policy, or I might be onto something along with maybe what other individuals are doing, high net worth, individuals or corporations, banks, things like that. So that's important to know. Now, regarding the split design, this is what you would call a 90-10, where instead of me writing a traditional whole life policy where I take 100% of the client's money and I just dump it into premiums, which will eventually build cash value over time, I am actually at a huge, huge loss as an insurance agent. So this is something that you have to personally decide whether or not you want to dedicate the time into doing this, because you are in fact you're getting a haircut in terms of your commissions, because we all know that we make money off commissions. So here I am designing a policy where you're only going to get paid 10% off of $7,000 if you designed a policy for me. And I told you do it like this, right? If I was your client and I say, hey, design me a 10-90 split or 90-10 split, you may not want to do that, because number one, you're cutting your commissions greatly if you do a 90-10 split. So that is a dilemma that you'll have to overcome, whether or not you want to do it. Now, from the client perspective, you're giving them a significant boost of early cash value or high cash value life insurance in the beginning years that they can borrow from day one, no restrictions, right? And in return, you might make up for that in volume. The client speaks highly of you, and you start really building a nice book of business. And this happened for me very quickly. A lot came from referrals or just me marketing this type of design, and then just being transparent with the process. So 90-10 split is what this is. $70,000 a year going into a whole life insurance company or a mutual life insurance company. The product is whole life or high cash value life insurance, right? For doing this, me personally at 24 years old, I have $4 million in death benefit, right? Of that $4 million, I want to say more than 50% of that in the beginning years, in the first 7 years, is term, because it's the cheapest type of life insurance, right? We all agree on that. So I'm taking the cheapest type of life insurance to increase my MEC the highest possible, and then I'm dumping the rest of my cash into straight up PUA. paid up additions according to the IRS limitations or the certain company limitations. All right, so Guardian has limitations, Mass Mutual has different limitations, Lafayette, Penn Mutual, Mutual of Omaha, everyone, they all have their different limitations and language, code, thing like that they go through. So that's how we're doing that when you're in the actual like software of it. So now let's go over the different options to be really transparent here of what other life insurance agents or agencies will preach out there in the marketplace. Specifically, I see it a lot on YouTube, right? So you've got 80-20, you've got 70-30, and then you have 60-40, which just simply means of the 70 grand, 60% goes towards cash, 40% towards base premium, or 70% towards cash, 30% towards base premium, right? You get what I'm saying, right? And like I said, if I'm going too fast, cut me off, ask a question. I want it to be, interactive and in case I'm going too fast. But these are the.
Is everyone good so far? Let's just ask. Anybody?
I have a question.
Yep.
Okay.
So when you say the split design, is the 90% of the term or the whole life, or is the 80% the whole life, or the 20% the term? Where you putting the money?
Right. So with this $70,000, this is principal. This is my money, right?
Mm-hmm.
And then I've got 10% that goes strictly towards permanent life insurance, whole life premium. The other $63,000 goes into a PUA blended term. So it's cash value, which, as you may or may not know, the PUA also buys me more permanent life insurance over the years. And I'll show you guys my illustration if I can find it, where it kind of breaks it down. But then a small portion goes towards term, and the term is what buys most of my death benefit, right? The $4 million. Now, if I put
the cash value, right? There's no cash value. There's no cash value building on the term, only in the permanent part, right?
Correct. So the term, right, is just term. Now, when you have a blended term, you are in fact a little bit of that is in fact going towards cash value. And I'll show you an illustration where it kind of breaks down the different columns. And there's different ways to do this. I only talked about one, which was annual renewable term. The other one is called convertible term. Now, the con to an annual renewable term is that the cost could go up depending on the person's age and depending on how much money we're putting into it, right? So an annual renewable term, the term rider renews every year. It's only 1 year term insurance. With a convertible term rider, the number stays the same, the death benefit stays the same, and then you have your PUA, your pure PUA, and then you have your whole life. So those are the different splits, right, of where my money is essentially going, right? So base premium, cash value, right? And then I would say the other thing is fees, right? You got the sales load, you got the PUA rider fee. The insurance company overcharges us for life insurance in the beginning years, right? So, you're at a loss essentially. When I put in 70 grand into my policy, I did not have 63,000 in cash value to start with. It was more like 60,000, right? So I'm already in the hole $10,000. But when you compare a 90-10 split to 100% type of policy, my money breaks even in the first 4 to 7 years, as opposed to 15 years later or 18 years later or 20 years later, when the amount of money I paid in premiums finally comes back to me in the form of a dividend,
Right.
which we all know is a return of premium.
Mm-hmm.
Okay. So the different splits again, 90, 10, 80, 20, 70, 30, 60, 40. Now, why would an agent do a 60, 40 or 90, 10 or 80, 20? This is going to go down to, like I was saying earlier, a conclusion of facts and opinions. Now, I'm telling you, as an insurance agent, we already, we get paid off commissions. So if you designed a 90-10 split, you're getting paid the least amount of commissions. If you do a 60-40 split, you're maximizing your commissions, but not necessarily maximizing the client's cash value in the beginning years. Okay. Now, the argument that you could make is that over the long haul, on a 60-40 split, because whole life premiums provide, so this is a fact, whole life premiums provide stronger dividends. Are we aware of this? For most of us in here that sell whole life, you understand that the premium, the whole life premium part, the insurance company tend to credit a stronger dividend towards premiums versus straight up PUA cash value.
Okay.
Okay. So what an agent could do is say, hey, you're going to take a hit in the beginning years if I do this 60-40 split, but over the long haul, you'll have a stronger cash value performance than, say, a 90-10, or an 80-20. That's a very strong argument to make. A lot of insurance agents, a lot of influencers on YouTube will pitch it that way. Me personally, I like to have as much cash value as I possibly can according to the MEC laws, and have long-term cash value performance later on as well. Okay. Now, there is a in-between design, like I would call it maybe like a happy medium, right? Where it's a 75-25 split. Meaning, if Crystal is my client, right? And Crystal tells me, Denzel, I want to be able to do infinite banking until I die. I want to fund this thing for my whole entire life. I want to maximize my cash as much as humanly possible for as long as I live on planet Earth. Well, it would be in my best interest to design her at least a 75-25 split because of the MEC laws, specifically MEC laws here. You cannot overfund a life insurance policy on a 90-10 split for 40 years, right? So coming back to my number here, $70,000 a year. If Crystal wanted to put in $70,000 for more than 25 years or like a really long funding period,
Wow.
she has to have a strong base premium to provide that much of a death benefit, but also remember the term. Remember, it's super expensive later on. So if she has, like a $3 million term life insurance policy for the next 30 years, that thing is going to be extremely expensive in the later years. And it could really affect her cash value performance. So a happy medium, in my opinion, would be a 75-25, because this allows her to keep putting in 70 grand for a longer period of time. And then we don't have to have the term rider for so many years.
Right.
Right.
Okay.
Yeah, go ahead. Anyone have a question?
I have a question, Denzel. So in the 75-25 split that allows her to fund for a long period of time, that 25 term policy would term out at maybe 7 years, 10 years, 7 to 10 years.
There you go. Yeah. So with the 75-25, in the very beginning, the client is taking a haircut, right? Instead of a 90-10, Crystal now has 25% of her 70 grand going towards whole life, right? So 70,000 times 25%, $17,500 as opposed to $7,000. The only reason why I would write her that is if she's like, Denzel, I want to fund this thing for as long as humanly possible. I want to lock in my health rating now because I believe I'm the healthiest I'm ever going to be now.
Okay.
I don't know what will happen later on. But if I lock this in now, I'm at least guaranteeing myself the flexibility to not have to open a second policy later on. Okay. So here's another personal opinion here. There are insurance agents that do something called churning. That's against the law. We all know this. But there's a way to sell it where you can convince your client to do a certain design on your first whole life policy. And then 4 or 5 years later, once you've gotten past all the insurance expense, they'll convince you to borrow the cash value out of that, start a new policy. And they'll somehow create a message where you're going to earn dividends in multiple companies and you're going to have all this money. I do not sell that. I personally believe that should be frowned upon. I don't like that. The only reason why I would sell Crystal a second policy is if in 4 years or 5 years from now, she's like, Denzel, I got 10 new rental properties. I started a second business. I 10x'd my income. Well, now she has more liquid cash to store away instead of having it sit at Bank of America at less than 0%. Then that would make sense.
Right. And in that scenario, I would just have maybe another 2 or 3 infinite banking policies, correct? If my health could support it.
If your health stayed the same, yes. Or what I'll do, because I'm very kingdom oriented, and this is my personal opinion here, is I'll say, okay, Crystal, what about husband? Let's get him in line.
Let's pray him in.
What about the kids? Let's get the kids in. So before I put a second policy on Crystal, I want to get the whole household secured. And create a culture around building high cash value life insurance policies that perpetuate wealth, tax-free transfer of wealth, right? And it creates a culture where it's just second nature, right? The legacy, the kingdom authority, the kingdom building part. And then if there's still more cash, then I come back to Crystal and say, all right, let's get another policy in place.
Yeah.
So 75-25 is a happy medium. It makes sense for the insurance agent. You're still getting a nice payload there, but you're also being very ethical at the same time because you're saying this only makes sense if you want to go long term. And this is the argument that a lot of insurance agents that do 60-40 splits, right, or higher, is they bring up that argument. Oh, the base premiums provide a stronger dividend. So therefore, the cash value will exceed a 90-10 split. And in my own personal experience, I have not seen a policy actually do that, actually beat me out in a 90-10 split. Because if I have the ability to put in more money than you can, and we have the same MEC limits, right? So that's the differentiation here is, let's say Crystal has a 75-25, Denzel has a 90-10. Let's say I desire to fund my policy forever, but my insurance agent didn't inform me that I could actually do that. I'll be upset because I'm putting in 70 grand for the first 7 years. After 7 years, the term drops. What happens when the term drops? So does the death benefit. So I'm just left with my PUA, my cash value that built up in those first 7 years, right? Now, according to Guardian and their PUA limitations, and you can look this up with different insurance companies that you broker with, is Guardian allows us to put in 3 times what the base premium is. So 7 times 3 is 21,000. So Guardian will allow me to put in an extra $21,000 on top of my base premium. So the total is $28,000 for as long as I live. There's no term rider after 7 years. There's no need. So now bringing in whole life, how I was saying earlier, how whole life is expensive in the beginning or could be zero cost later on. Here's my point. I dropped the term, so I took advantage of the cheap to increase my MEC. I took advantage of whole life and the strong dividends. I also took advantage of the PUA, the pure PUA, 21,000 pure PUA, no term. So I reduced my costs on that. And I also lowered my cost of life insurance on $4 million. What's beautiful is when I'm 87 years old, if I pass away at 87, my death benefit might be in the neighborhood of $8 million or $9 million. So it actually increases over time.
Because, or higher even.
Because, right, or higher, because my PUAs buys more permanent death benefit. So the ratio that you can write down is for every dollar that goes into cash value, you'll average about $3 in death benefit. When the client asks you, hey, do I get my cash value and the death benefit when I die? Your answer is yes and no, right? Because yes, for every dollar that Crystal put into cash value, she got $3 in death benefit. So it multiplied her death benefit while she was living. When she dies, she gets that total death benefit paid out to her. No, because if Crystal had $400,000 in policy loans, which would be ideal, right? You want to have the money working for you outside of the policy as well, buying real estate, that's the whole idea. We don't want to just have it sit there and do nothing. Although it's a nice place to stockpile cash during COVID, during 08 crash, during black market crash, during all that. So it's ideal because you still get your guaranteed 4%, which is why I like working with like the mutual life insurance companies. They usually give that guarantee of 4% is the highest that I've seen. And then that surplus. But that's what you would say. You say, yes, you do get all your money. So if Crystal had $400,000 in loans, but she had a $5 million death benefit, she died while the $400,000 was in loans. 400,000 minus 5 million, 4.6 million paid to her family. Crystal's not going to be angry about that.
No.
Because she had 400,000 working for her in real estate, which she flipped 10x, and it's really $4 million worth of real estate working for her. So that's the kind of the high level strategy that you would talk to your client and coach your client on as they progress throughout the year.
And that's part of what we're excited about, Denzel, is teaching the concept so we can educate and empower clients that are in the position to do this, to have their money make money, so they can go and do some other things in life. So yes. Are you familiar with, I heard you say Lafayette earlier. So that is one of the carriers that we're using. So.
Yeah. So I'll try and write a little list up here of different carriers. And now what we can get into is the different players, right? Because the issue that every insurance agent is going to have, and I had this same problem, was you start talking about infinite banking. It's a very attractive concept.
Right.
But not only is it very attractive, it's very time consuming, right? You have to educate your client, right?
Mhm.
And
Mhm.
you do not want them to have buyer's remorse,
No.
right? You sell a $70,000 policy and they cancel it in the second year. That's going to look bad on you, right?
Right.
You don't want that. So you really want to qualify. You really got to qualify
Mm-hmm.
your
Big time. Can
prospects.
you underline that or make that bold?
Because because this isn't a regular traditional life insurance. It's not a regular traditional whole life or term. We're dealing with something that involves culture, involves history. Like if I'm dealing with a family that is in debt, bad credit, bad cash flow, they're not going to comprehend this, period. I don't care what family, what creed, what religion, it doesn't, none of that matters. It's about their personal understanding of financial management. So I try to really qualify my prospects and also bring them back down to earth and say, hey, maybe 70,000, maybe not. That doesn't make sense. Let's maybe do debt snowball. Let's pay off some debt. Let's get your credit up. Let's start a side hustle. Let's start a business. Let's create more income, and then revisit this in maybe a year or 6 months.
Mm-hmm.
Doing that is going to retain that client, and then they're going to send you their whole family to you. So you actually make more money in the long haul if you really qualify your prospects. And it also saves us time, us agents time.
Right.
Let's say you're talking to a 24-year-old kid. His name is Denzel. And I tell you, I want to put in 70 grand. What are you going to do to qualify me? What do you do, Denzel? Oh, I'm a truck driver, or I do janitorial services. Now you might say, well, do you own a janitorial service? Because they don't make too much money. Or do you own your own truck? And is that why you have so much money? Or, but you want to bring it up very cordial. And what's nice about us as insurance agents is that we get to ask that personal information, because at the end of the day, they're providing us that social security, their date of birth, their first name, last name, their house address, and life insurance, as we all know, is based off age, health, and finances. So we can ask them for their 2019 annual gross income. You can ask that and say, okay, I need you to provide me your W-4s. What do you currently make? What did you make last year? And then that will save you time, rather than having the insurance company, if you're working for Lafayette, having them do the homework after you just had 5 phone calls with them, teaching them the concept. Yet they're not even prepared to put in 70 grand, yet alone $7,000. You know what I mean? So this will save you a lot of time. Qualify your prospects, saves the agent, saves us a ton of time.
Mm-hmm.
And it's based off age, health, and finances. So that's a really, really good thing I would leave you with. Now, let's also talk about the players. Now, the one thing this is personal opinion, there is a vast amount of negative heat towards the infinite banking concept. It gets a lot of heat, a lot of hate, simply because we're stealing business from traditional way of doing things. It's very easy to sell a traditional whole life policy, a term. There's no real, if you got a good voice, if it's not hard to sell, right? With some training, you'll be all right. But with this requires more time. And you got to understand, you're also competing with the financial advisors. Every single financial advisor I've ever met so far is totally against life insurance. But it baffles me, because when you look at the Rockefellers, the Rothschilds, Walt Disney, Donald Trump, any high net worth politician, all these guys got life insurance.
Yeah.
All of them.
Yeah.
Every dynasty, what's that show? Duck Dynasty? Is that show? They're out in the sticks. They got life insurance.
Mm-hmm.
I promise you, all of them got life insurance.
Yeah.
All of them. Doesn't matter the creed, the race, religion. This is a culture that we're dealing with when it comes to finances. So
And can I just say
Go
on
ahead.
that note, I was introduced to a WNBA basketball star, had the best conversation with her. She was so in 100%, spoke with her financial advisors, and they told her to stay with her 401k.
Yeah.
Yeah, so it's bananas. You are competing. You are competing.
So
Because
yeah.
people don't understand it, and,
Mhm.
and if they do understand it, they're running away from it
Yeah.
because it's going to take money out of their pockets, basically.
Exactly. You're taking a lot of money out of these guys'
Mhm.
pockets because you could, if you're good with numbers, anyone watching here, you could make a very reasonable argument against the 401k plan. The max you can put in a 401k is $19,500, right? I think,
Mhm.
or like say 20 grand. If you were to run a scenario on a 40-year-old male or female with an infinite banking illustration, like a 90-10 or even like a 75-25, 20K into high cash value life insurance or 20K into your 401k. You could make the argument that the life insurance policy would in fact benefit that client more than the person putting in 20 grand into their 401k, no matter how much they're being matched. Number one, they have to deal with market losses, COVID, the next COVID, right? The next '08 crash. Every time the market goes down, they lose money in 401ks, period. They have to deal with the high cost of fees. I've never met a single American citizen yet, and I work with hundreds of families so far. Not one of them could tell me how much money they are being charged in their 401k
Absolutely.
annually.
Absolutely. Mhm. Yeah.
So they got to deal with the high costs and fees,
Mhm.
market loss every 4 or 5 years, or every time it goes from Democrat to Republican. You see a dip in the market, that happens. And then you've got to deal with Uncle Sam when it's all said and done. You did not get a tax deduction. You got a tax deferral, right? So it lowered your taxes now, but taxes go up later. They always go up historically.
Hello.
They keep going. So you got to deal with all that. Life insurance is tax-free. You know your cost. It stays the same, the cost. In fact, with infinite banking, it goes down, right? And I have my cash liquid. Oh my God, COVID hit. I lost my job. Let me take out a cash value loan at 0%. Doesn't cost me anything. I can offset that. Let me pay off some debts. Let me get my house in order. Okay, now I got my job back. I'm gonna pay myself back. I earn uninterrupted interest in that policy.
That's a beautiful thing. Uninterrupted interest. I don't know if everyone was aware of that, but
Yeah.
that is definitely a part. All right, Angie.
Yeah.
That is definitely a part of the IBC factor. So
Mhm.
yes,
Your
I'm due
ability
to
to
celebration too.
exactly your ability to grow your money uninterrupted, because when we take out a cash value loan, the insurance company collateralizes our cash value and they just minus it off our death benefit. So that means my cash value, that 60,000 or so that's growing for me, stays at 60,000 at 4 to 6% guaranteed no matter what every single year. And then the insurance company charges me a loan interest rate equal or less than the dividend rate of the company, so that I don't get dinged, right, for taking out my own money. No
Lafayette,
matter,
I believe, is 5%.
yeah. So Mass Mutual is also 5%. Guardian is a little bit different. Guardian is a direct recognition company. So when I take out, so right now I have like 70,000 in loans right now. If I pay it back early, Guardian will just refund me the interest that they charged me for the whole year if I paid it back in 6 months or if I paid it early. But what they also do is they actually credit me the same interest rate on the loaned amount out equal to what they're charging me, so that there's no net difference. It's so confusing, but at the end of the day, I still offset. It's still zero opportunity cost to borrow from myself, to finance from myself. So we get that living benefit, right? And then most of these whole life policies come with chronic illness rider, no extra cost, or terminal illness rider, no extra cost. And so I get access to that death benefit. Something really happens to me. versus a 401k, I'm just shit out of luck. I mean, it's like the money could, excuse my language there, but I could really lose like a lot. And then, I get a little passionate about it because, I come up from a family that does not have wealth, and still to this day, they do not own anything in their name. The Rodriguez family is still, it's like, there's a lot of us, don't get me wrong. The Rodriguez, right? We know how to make babies. That's what we're good at. But we don't know how to supply those babies with financial wisdom, what's going on. So that's like my whole, so you're getting that kind of passionate,
I hear you. I hear your heart. Mm-hmm.
So I have Denzel.
Yes. Leona?
Yes.
Yeah.
Okay, so I'm sort of familiar with the index universal life, and with the whole life, because they use the guarantee, and the index is in the market, but not really in the market because they have the floor and the
right,
the ceiling and the floor, right? So
the ceiling and the floor, right.
Are you saying that because the whole life offers the guarantee, because it's always going to be there, where the market, the floor may be 0 or 0.75, so
right,
still getting something, but it would still wouldn't be higher than what the guarantee is. But then in the index, it could go as high as 25%, right?
Correct.
So I think what I'm asking, and is there a surrender value? I mean, like, do you have to wait? I know y'all was saying when you can use it within the first 2 years of the plan, but are there surrender values? Like some companies have a 15-year before you can do anything.
Right.
Like, right there. Like if you did $1 million baby plan, right? A baby come into the world, 14 days later, you got them on their own plan. The 15 years really has no issue because the parent is overfunding that plan.
Yeah.
So would that work with the whole life? Would it work faster with the whole life for the child, or with the, you know what I'm saying? I'm just trying to get a feel for the total difference between using the whole life company
versus
index.
Yes, let me go back to sharing my screen here. And so I'll mention the players later, right after I answer Leona's question here. So with an IUL policy, and then versus, right, whole life. So with the whole life example on a child, right, or a baby, with certain life insurance companies. Now, I prefer, like I said, personal opinion here, I like to use sort of the bigger mutual life insurance companies that have more flexibility, right? So we were going over policy design earlier, right? In terms of the splits of what we can do, 60-40 or as high as 90-10. Another personal opinion here is anything past 60-40, in my opinion, is a no-go. And it's just my own personal opinion, only because, like, at that point that the client really isn't experiencing the high cash value. It's going to be a hard sell to put 50% of their money towards premium and 50% towards cash, whether they're doing an IUL or a whole life. So with a certain life insurance companies, for example, Guardian and Mass Mutual, this is what I know so far, is when I funded my policies day one, I was able to borrow from it day one. So even if I was a mother or a father and I put a policy on my child, and I'm able to get 50% of whatever mom or dad's death benefit is on the minor, right? I believe that rule applies to like all life insurance companies. So whatever the base premium is for the child, and then whatever goes towards cash, right? And depending on how we design it, if we did a 90-10 split, right? And let's say, I know I wrote a policy on a 2-year-old a while back, and I believe we were able to put in $2,400 a year, right? And divide that by 12, it's $200. He was originally putting in $200 into a college savings plan. And then this particular client I'm working with discovered infinite banking and then decided to work with me. So we're putting in $2,400 a year, right? And then we times that number by 10%. His base premium, if I'm not mistaken, if I remember properly, was $240, right? For the 2-year-old. I think it's 2 or 3 and he's a male. So 2,000, and I think there's some echo or some background. If someone can, that might be Leona or
Granville.
Not me.
oh, okay.
I did. There you go.
Okay.
Thank you, Granville.
Appreciate that. So
I'm sorry, I didn't even know I wasn't on mute.
That's okay.
You're good. So 2,160, right, is what's going towards PUA. Then we have the term fee, or I should say the term rider. And then we have the PUA rider fee. So minus all of that and then the internal costs, I'm left with about, let's say I'm left with maybe $1,900 starting cash value day one for this policy. Okay, let's just say. The insurance company with Guardian, they allow me to borrow up to 90% of what is available in cash. So those are the only limitations that I know of so far regarding MassMutual and Guardian, because those are the only 2 insurance policies that I have so far. Is I'm able to borrow 90% or probably like 89, 88, like in the first year. The other 10% has to stay. That's the rule that they have. Does this answer the question a little bit more in terms of surrender values? So if I think when we start talking surrender values, that's when I want to cancel or kill a policy, correct?
Yeah, when you want to borrow from it or take away from
So when I'm teaching infinite banking, I never teach my clients to kill policies or to cash them out in the later years. What I do tell them and say, look, if you don't want to fund the policy anymore, we could explore reduced paid up, which is nice because that's essentially what we're designing here. So my policy, my 70 grand a year policy, it's a 7 pay. It's paid up in 7 years. That's $490,000 in principal, right? That's my own personal financial goal, to get about $500,000 into, one policy in the shortest time frame, according to my numbers. So that's 70 grand, right? Times 7, 49, boom. After the 7 years, I could do what's called a reduced paid up, get rid of the 7K base premium, and I'll have more than $500,000 in cash value as a tax-free personal line of credit. So it'll be a tax-free personal line of credit that earns interest, right? Because you can dip into it at any given time. You get access to your money within a few days via direct deposit, or if you do a check, it'll take a couple weeks, right? So with the surrender values, I believe they go to, if I'm not mistaken, after X amount of years, depending on what insurance company you're with, there will be no surrender values. And this is both with IUL and whole life.
Right.
I had a client that I think had an IUL or VUL with New York Life, and he has 2 policies, and he's got about 150,000+ or so in cash value built up over like 10, 12 years. And we did a 1035 exchange. I'm not sure if you guys are familiar with that.
Mm-hmm.
We did a 1035 exchange into a new policy with Guardian. where he's funding like 70, 80 grand a year plus that 150. So he's got like more than 225,000 cash value to start with. There was no surrender charge to kill that policy and move it over into a new policy. The only drawback to a 1035 exchange, obviously, is that he has to repeat the early years of funding a new policy. The only reason why we did a 1035 exchange is because he was very unhappy with his insurance agent because he didn't realize what he bought. And that happens often in our industry, is we just sell policies without actually knowing all the intricate, movements and parts. And I would say anyone in here that's selling IUL, you have to work harder, in my opinion, because IULs are constantly changing. They're upgrading, changing the language and contracts. So you really got to keep up with it, which I think, if that answered your question, was that good? Because I'll go right into the players now, because this is a good segue now.
Yes.
Denzel,
Okay.
this is Elaine.
Hello.
I had a question that was similar to Leona's, and because I saw an IUL illustration for infinite banking, so my question was going to be, maybe this is your personal opinion, and I've also seen some things on YouTube. What's your I'm gonna ask this. I just heard what you said. If you had a choice between whole life and IUL, or is there a significant difference? Do you recommend that we use an IUL for infinite banking? That's basically what I want to know.
Yeah, so that's going to boil down to a personal opinion. Now you are talking to a 24-year-old, so haven't been in the game that long.
Mm-hmm.
But me personally, I have not made sense yet of establishing an IUL policy. Number one, because I haven't found the right agent yet. Number two, when I look at actual historical performance, there's only about 20 years of history with these IUL policies, because if I'm not mistaken, I believe they started in the 80s
Right.
or the 90s.
Yes.
So it's a fairly new product. Now, the other issue that I have is the additional cost, the underlying cost in IUL policies. Typically, the insurance company has the right to change your fees at any given time.
Right.
Now, this when you read the contracts, they have the right, they reserve the right to kind of change tweak some things along. And I guess the other issue that I have is like keeping up with the Joneses almost. It's like every year there's a new IUL product that comes out. And I'm like, well, is that better than the one I just bought last year? And then your client says, hey, why didn't you tell me about this? And then now you got a client that he or she leaves you because you didn't tell them.
Yeah.
You told them this or that. And I would say, so those are my three main issues. I'm in the process of actually designing an IUL policy, to be super transparent. I'm working with a company called World Financial Group, which is an MLM structure, network marketing, right? Direct sales. And so really I'm kind of going undercover and just kind of witnessing, okay, how do you do things, right? And personally, I had a terrible experience so far. Because
well, we can certainly concur with you.
yeah,
Okay.
and not to bash anyone, this is customer service, right? The insurance agent, see, I ask questions. I'm a very curious Puerto Rican and Colombian individual. I love God, and it took me a while to find him. And when it comes to finances, it took me a little minute. I ask questions. I'm very curious. So I was really drilling a higher up dude that sells strictly, IULs, couple whole lives, couple terms. And one thing he told me was that if your client or prospect gives you a lot of, heckles you around and stuff, here's how you can tweak the policy to earn more commission by simply increasing the fees via where your IUL gets invested in which particular index fund. And that threw me off. I almost lost it. I was like, why would you do that? Like if I'm dealing with a 65-year-old woman and I have the option between 2% flat fee or 5.6% annual fee. I mean, and if she's asking me a lot of questions, it's only because she's genuinely interested in learning. And so you're going to charge more for the amount of time that you're going to put into her. Come on now. I didn't like that. So I was like, I'm playing dumb. I was like, oh, really? You earn more commissions? So, that's my own personal experience. So if anybody in here was a part of WFG, no, I'm not bashing. I'm just saying this is what I went through. You know what I'm saying? It's like, I didn't like that. So I haven't found that aging
player. Right. I just want to say one thing in to address the IUL versus the whole life scenario. In my brief education of infinite banking, the most simplistic answer that made sense to me was a whole life is preferred, because we know, even though we don't experience any of the downs of the IUL, if there's ever a flat year, there's no money to generate money. So whole life has steady guaranteed growth. Remember when Denzel talked about that guarantee? So that's one reason that just made mega sense to me why you always want to stay in the whole life camp.
Mm-hmm. Yeah,
Right.
and I'm genuinely interested in IULs and learning more about them. It's just now segueing, if I'm going to share my screen again, into the different players that sell infinite banking. So one of the biggest players, his name is Nelson Nash. Now this man passed away last year, and I would call him the godfather of infinite banking. Like that's what he coined it, or another word was become your own banker, because that's essentially what you're doing. Is you're taking control of the banking system. You're becoming Chase for the Rodriguez family. You're becoming Bank of America for the Nunley family. Right. Instead of going to Chase to borrow money, I'm gonna go hit up Auntie Elaine for a loan at 1% to the cousin, and cousin pays back. And so now you're talking into kingdom stuff, and perpetuating, circulating money within your culture is very key to perpetuating wealth amongst your peers, which is important. Right. So Nelson Nash, I would read any of his books. They're pretty interesting. And I want to say that he was in the realm of 60-40 and maybe 70-30, if I'm not mistaken. All the living insurance agents that I've met under Nelson Nash or Nelson Nash Institute, a lot of them are doing 60-40, 70-30. Some of them are doing 50-50, which is against Nelson Nash, but he's dead, so he cannot keep up with these gentlemen anymore. So again, you're going to have a lot of competition, a lot of negative heat. You're going to have to break past all of that, right? In my own experience so far, and I get a lot of heat. I have a big channel now in terms of our space of the insurance space. Got 30,000 plus subscribers. I get heat all day long, with, oh, who's this young kid? You don't know about Jack, but that's okay. It's only a matter of time. Get more experience. So Nelson Nash, you got another great gentleman. This is a living person. His name is Garrett Gunderson. I like him a lot. He talks more tax strategy than infinite banking, but really brings up infinite banking quite a bit. You've got VIP Financial. And by the way, most of these guys that I'm listing are pro whole life and very anti IUL. So if you hear these guys talk about IUL, it's always going to be negative, really nothing positive. If you want to find people who are kind of transparent around whole life and IUL, there's a gentleman, Oregon Cash Flow Pro. I've heard him talk about it. Very mellow, straightforward kind of guy. So you can look, these are YouTube channels that I'm naming right here that you guys can look up. So I think he does IUL and whole life. He's very transparent. WFG, that's MLM or network marketing. And I would say they're more on the IUL side of doing things. And
LGS Lafayette.
Say again?
was listing our company. I said you can put iLeverage or LGS, and we deal with Lafayette.
iLeverage. What is iLeverage? Is that another type of
that's our
network
company.
marketing?
That. Well, we're affiliate. I wouldn't say we're network marketing. No.
Okay.
We're
more affiliate.
More brokerage type.
Okay. So
I
you got, so iLeverage, and you only work with Lafayette?
Thus far in this market.
In this okay, got it. Yeah, Lafayette is pretty popular amongst a lot of these guys. A lot of the Nelson Nash guys, they'll use Lafayette. Penn Mutual is pretty popular. Mutual of Omaha, Mutual Trust. Me personally, I only use Mass Mutual and Guardian so far. The companies right behind these two, I would give it to New York Life and Northwestern Mutual. These are the giants in terms of the mutual. And you can look at these guys as net annual incomes, annual revenues per year. They're in the multiple billions in revenue. I think when it comes to Lafayette, Penn, Mutual Trust, then you've got Security. I mean, you could just go on the Forbes list and see where they're ranked. I think they're like in the 300s or 400s. So versus Mass Mutual's like ranked 77. So there, you have to come to that, like I said, conclusion of facts and opinions and kind of work your way through it, and see ultimately who you want to work with. But the other one was PHP, and I think they do whole life and IUL, if I'm not mistaken. If anyone knows Patrick, David, I think it's how it's spelled, and his YouTube channel is called Valuetainment. Check that out. He'll talk about cash value life insurance. So really, all of these guys are either doing whole life and IUL, or strictly whole life, or strictly IUL. What I did is, I try to find someone I know, like, and trust, that's willing to walk me through the entire process. Preferably someone with a infrastructure, like they, has an agency. Now, I think you guys probably already have this in place, agency, you already have the infrastructure, the policy, the design, the softwares, you're already licensed. So I think the only thing you're missing is really kind of which strategy kind of iLeverage as a whole is going to kind of, go in, and then figuring out who are the case designers going to be, right? Because me personally, I am not a case designer. I talk about the concept. I practice the concept myself. But when it comes to case designing, I am partnered with an agency called IBC Global Inc. And I send my illustrations and designs to them personally to work with all of the leads and customers that I get that funnel through my YouTube channel. And so they have an agent training program coming out soon that's super transparent, that will go over, I believe, whole life, IUL, all the different companies that you can go with. And I would say it's like a nice starting ground. You can also visit their YouTube channel, IBC Global Incorporated. They have a very nice YouTube channel. Partner with them. The owner's name is Steve Parisi. Real straightforward guy. Like him a lot. But here are the kind of like the big players in the space, and you can see how they operate. Like I said, anyone that goes past 60-40, I don't like doing business. I think you're more on trying to increase your commissions rather than helping the client. Anything 60-40 and down, I'm cool with you. I guess we'll have some fun together. Me personally, I do most of my policies as 90-10 splits. I do not make most of my money in the infinite banking space. I make more of my money outside the strategy. What are we doing with the policy. That's how I make my money, whether it's in investing, financial coaching and consulting, different affiliate, programs and services that I offer. So I do 90-10 splits. And then the only reason why I would go anywhere higher is, like I was telling Crystal earlier, is this is kind of like where I kind of stop. So I'll do anywhere between 90-10 and 75-25. I don't see the need to increase the base premium for the sake of stronger dividend performance long term, because I can get the same performance, if not better, for less cost. And I think that is a home runner for the prospect, for the client, because number one, I don't want to create a mech. That's the key. Don't create a mech, right? Run your mech test. And I guess what we can do here is I'll just show you guys my policy. You guys can kind of get a little insight of how exactly the stuff looks. And then I also have a policy with Mass Mutual, which is a much smaller policy. It was the first policy I established when I first got involved with the concept. And that was simply to kind of test things out. And I'm in the process, like I said, of doing IUL as well, putting in like 15,000 a year. My problem is like I was saying, is with the agent. Number one, I haven't found the right agent. Number two, the ethical approach, don't really care for it. And number three, the fees are extravagant. So even if I was making a 25% return, when I look at the internal fees and the annual fees, it really knocks that performance down. And I don't know how many years I can bet on getting a 25% return or a 20. So, kind of going back to that question, which one's better? I think this also depends on the client. Me personally, right? I work with majority, say between the ages of 45 and 55 and older. And I have heard a lot of qualified, very credible IUL agents tell me that if the person is older, like over 60, over 55, IUL's not that great. They get really expensive when they hit 70 and 80 and could potentially become a mech. The reason why a lot of policies, a lot of IULs become mechs is because they weren't being maintained, right? They weren't, the insurance agent needs to know when to switch the index on the client to something more conservative or something more aggressive. If you don't do that, and you're running an illustration off of this rate of return, say 8 or 7 or 6, but then you're actually doing 2 and 1 and 3. If you do that for a few years, unmanaged, you could potentially increase your chances of becoming a mech. Now, to be super transparent, no matter what you do, and this is what I learned so far, is the minute you start overfunding any type of life insurance that's permanent, right? Your chances of becoming a mech do increase. So let's say you wanted to implement kind of like what I do with the whole 90-10, right? 90-10 split, or as high as 75-25 in this range. You'll hear a lot of these guys, they'll bash the heck out of you. They'll say, oh, don't do that because the policy will become a mech, right? Now, this is just going to boil down to opinions, right? There's not too much factual evidence of why a certain design will or will not become a mech. The reason why is because the client overfunds the policy too much or too long. So that's why you want to ask your client. So if I'm working with Crystal, how long you want to fund this? Or how long would you like the ability to fund it? If Crystal told me only 10 years, it would not make sense for me to design something this high for her because I can do the same thing as a 10 pay, a straight up 10 pay 90-10 split, no strings attached. After the 10th year, we can do a reduced paid up, no questions asked. The policy never becomes a mech, guaranteed. Or I can keep the policy open and just pay the base premium for life, never create a mech. I'm fine. But if she wants to go much longer, then yes, we want to maybe 85-15 or 80-20, but haven't found the need to go past this, because when it comes to the Guardian, and this is why, Guardian allows you to put in 3x the base premium. So if I had a 75-25 split, right? Let me let's put it right. Yeah, so if I had 70,000 times 25%, that's $17,500 base premium, right? And then the rest of my money is going towards PUA and the term and the internal costs and all that good stuff. So I'll definitely have less than, you know, 52,500 in the first year, as opposed to having 60, but that's okay. My intention is to fund it longer than 7 years or 10 years. So after, say, 7 years, the term rider drops. You have to design it this way, right? After 7 years, the term rider drops. Then it is straight PUA, right? 17,500 times 3 is 52,500, right? So for a total of 70K, perfect. I don't have to pay a term rider. I don't have to pay a convertible term, because that's another strategy that a lot of insurance agents will teach, is like they'll say, okay, put a convertible term and you can convert that term to a whole life later on. The issue with that is
You times that by 3?
Say again?
Or you get, so when I'm looking back at this, so it says 17.5 times 52.5. Are you times in that?
Oh,
or you?
I'm sorry.
Okay. I know you said times 3. Okay.
Like that.
Thank you.
Yeah. So 17.5 times 3, 52,500 pure PUA. Pure. Straight cash value. No term rider, no extra cost, straight PUA. I pay my PUA fee. That's it. And then it buys me more death benefit. The 17.5 is my base premium. That stays the same. Its whole life stays the same. Right? And then it equals 70K. So there's no, it's like the cheapest way, in my opinion, to get the most amount of cash for the longest period of time.
Mm-hmm.
If I had a convertible term, and I was just about to make my argument there, like kind of like why I wouldn't use a convertible term, is I still had that issue. I got to restart the policy again. I got to go through the funding, the early cost. Crystal's going to be 10 years older. You know, the health goes bad. You know, everyone's health gets worse the older you get. No matter what, these insurance companies are very good at predicting when you're going to die. I don't know how, but they're very good at that. Those mortality rates. It's kind of shocking.
Actuaries, right?
Actuaries, yeah.
While.
Yeah. So when you look at that, then that helps you kind of decide, okay, you know, which way am I going to go? Now, me personally, at the end of the day, I don't think you can go wrong if you did a 90-10, 80-20, 70-30, 60-40. You personally, as the agent, you're not going to go wrong. I don't think you're going to get sued or a lawsuit. I know this is what the other side tells our prospects, is they'll say, oh, your insurance agent, oh, a lot of lawsuits are going to come at you. a lot of this, a lot of that, because we're teaching it incorrectly. And in many ways, they are right. There are a lot of fraudulent. I mean, when I took the insurance state exam, the whole thing was about ethics. It made me wonder, why is that? Because there's a lot of fraudulent activity going on with insurance agents. So that's the reputation that we have to break past. And my goal as 24 years old is to create a new culture. Hey, it's not all about commissions. If you focus on maximization of what the customer wants, read through the whole contract, there'll be a book of business for you for life, and they'll work with you. So any questions on the players, the design? I was showing you guys my policy, and I can open up a couple more screens here. We can kind of look at this. Yes.
When I can wait, go ahead. I have it written down.
Yeah. So here's what my policy looks like.
Do you have the illustration, perhaps? Beg your pardon, Mel?
I said that was my question.
Okay, I read your mind.
Yeah.
All right.
So let me look.
Finish. That's my question.
Okay.
Let me look. Okay, now another interesting thing regarding IUL. What Guardian has done is they introduced what's called an index participation rider feature to a whole life policy, which becomes a hybrid of whole life and IUL while maintaining that 4% guarantee. So with Guardian, I could choose to have 50% of my money grow with Guardian and the dividends, the other 50% to go in the S&P 500 index and grow with a cap of 12.5% with a flat fee of 2% of whatever I put in. So in reality, your net return would be 10.5% if you in fact earn 12.5 if the market went up that high. So you would net 10.5, or if the market went negative, you paid your 2%, right? Your guarantee is 4, you actually net 2 internal rate. The benefit.
So it's lower 0.
So you're right. So I don't hit 0. Unlike if I had an IUL that has a 0 floor, which most of them do, or 1 or 2, when you factor in the cost to actually put my money in the index, I'm actually at a true 0 or negative. Right. So if my floor was 2%, but my net internal fee was 2.5%, like for example, a big company that WFG uses is Pacific Life. Now I was going through all the fees. If you go with their high performance index thing, it's like 5.25, or it's 5.6% on whatever goes in there. Well, if you're telling me I'm averaging a rate of return of 7 or 8, but I got to pay 5% in fees,
so I'm only going to get 2.
I'm in the hole.
Right.
If the illustration says and they're using that as a net illustrated 8% as a net rate of return in your illustration. If I only net 2 or a net 4, my chances of becoming a mech increase much faster. And if you guys don't already know this, every 7 years, the mech limit will readjust down. So with an IUL, they use the same thing, annual renewable term. If we're not able to drop the term because the cash isn't keeping up and the cost is so high, I'm in a pickle.
Yeah.
So what WFG teaches is to do a 1035 exchange into a new policy. They convince you to get the newest, greatest IUL design. But I'm like, why would you do that? Because I got to restart the cost again. Exactly. What are you doing? Scaring me. You're scaring me. So I don't think PHP does that, if I'm not mistaken. But I'm still learning. There's a lot of different ways here. But let me go ahead and share my screen and show you guys an in-force illustration for Guardian. I'm in my 2nd year. Okay. So I started it it says 2020 now, 24 years old, but I really started it last year when I was, 23. So I funded it twice so far. I put in a total of 140,000 in principal, current status, non-MEC, issue age 23 years old. I had 39,000 in loans, but as you can see, I've obviously increased that much more because I'm using it to, the way that I use my policy is I actually run my bills through my life insurance policy. I run all my business expenses and my personal expenses, what I pay myself. I swipe it on a credit card. I get cashback rewards, and then I pay the policy. I take a loan out for my policy to pay the credit card off. So I'm earning interest on money that I was going to spend anyway. It was going to leave my economy anyways. All I did was send it to my own bank first, and then I financed that. So I get a little creative there, but that's very, very little, right? It's not investing yet. That's a much bigger game that I do a little bit of. I did a fix and flip once where I was a part of the construction rehab. I gave 10 grand. They gave me back 12,000. That's a 20% return.
That's what we're talking about.
Yeah.
Yes.
It gets real fun. But any questions here on like what these columns mean? Are you guys kind of familiar with it?
I love to always show the net cash value. If you want to speak on that.
Yeah. So that is my net cash value, 131,000. And then if we go to the policy, 129,000. Why is that? The loan. The loan is outstanding. That's the loan interest. When I replenish that, then this 129, or I actually made a mistake there. This is net cash value at the end of the year. So I'm still, my policy anniversary date is June. So come June 2021, my cash value should be here. So right now it's at 129. And so look at the term. This is what I was talking about. Face amount of 1 year term. So, and then that's my base. So 7 grand gives me that. And then a couple $100 gives me that. Right? And notice how the death benefit drops year after year, all the way down to 0. So in some cases, the actual annual renewable term rider actually gets less expensive. Some cases it does not because of the person's age and health. But in my case, it gets less. It drops because I'm super healthy and I'm young. So I have those advantages there. And so eventually, after the 7th year, if I want, I'm not obligated to. If I want, I can add in another 21,000 into PUA, or I can just pay the 7 grand forever. So if I just did that, 490,000 total principal put in, and then just pay the 7K, either myself or I can have the insurance company pay for it from my cash value. If I die at 93, look, I was right. About 8, 8, that's not bad.
Yeah.
$500,000. And here's the key. I don't create a MEC. Very important. We do not want to become a qualified retirement account where I get taxed on all this money. Bad. Don't want that. So my MEC limit on this is 81,000. Guardian doesn't show it, but in their software they do. So I have an $81,000 MEC limit, which is $11,000 higher than the 70,000 that I'm putting in per year. So I created the space to allow me to, put in more PUAs.
So Denzel, the PUA is essentially to give you more, create space to be able to fund it more, right?
Correct. The PUA is the only way to accelerate an individual's cash value in the beginning years.
Okay.
Yeah.
Got it.
And another point that I love about the illustrations with the infinite banking is, let's say you were just parking money. I just want everybody to see from 1 year to the next, that phenomenal growth in the net cash value. And even after I guess it was the 6 or 7 years when your term stopped, it did dip. But if you go down a little bit more because your money is still making money,
Right.
it's picking back up. That death benefit has picked back up. And now if he wants to eventually pass away and leave money to his family, let's go down a little ways because you're young. And I think he already went there. You got, $8, $9, $10 million that's creating a family legacy. That's phenomenal. That's huge.
Yeah, this is a L95. So this is paid up at 95 years
95.
old.
Yeah, you might live a little longer, but that's $10 million. Let's say you live to 95 and say bye.
Mm-hmm.
Yes. Mm-hmm.
And so this is no joke, because now this is just one policy.
Right.
That I have the ability to put in so much money, rather than what quite a few other agents will teach is they'll promote multiple policies. To me, that's like churning in a way. It's like a legal way of churning. So I don't really believe in, because I feel like I can combine all those policies in one.
Right.
Right.
Exactly.
And if I'm dealing with a client that says, you know what, Denzel, I'm a truck driver, I'm a police officer, I don't make that much money right now, but I'm transitioning. I want to become an entrepreneur. I want to 10x my income. How can I get the most amount of death benefit today? I don't care what my split really is. What I'm honing in on is my ability to put in more money later on. If I design a policy like that, Denzel, so let's say I did a 75-25, right? They're going to put in 70 grand, but they only have 40,000 to start with. You could still, as the agent, design a 75-25 where they're putting it up to 70K for forever, right? And then as they increase their income, they can put in more money at leisure. So Guardian allows you to put in extra money at leisure without any medical underwriting, which a lot of other insurance companies will not do. So that's why you want to know the flexibility from company to company, right? So for example, Mass Mutual, you can only add in funds at the anniversary date, 30 days before, 30 days after. If you want to add in funds throughout the year, you got to fill out paperwork. They may put you through medical underwriting. Not the most flexible, right? Guardian, they allow me to, if I put in 40,000 today, 20,000 3 months from now, and then another 5 another month, and then another 5 the next month. No medical underwriting. I go right into my account. They have a mobile app, super friendly, I just dump the cash right in, no issue, right? Now, what if the client only has $40,000 for the entire year? Do they lose out on that 30K in year one? No, they do not. There's something called unused mech space or rollover mech space. So it'll roll over year to year. So if I'm dealing with a police officer, it's like, hey man, I want to secure my good health now. Don't know what will happen to me. I'm willing to pay a higher premium for the max potential of cash for my whole entire life with one policy. Okay, that's a good argument to make for you to earn a higher commission, because you have to increase that split, of course. And then as long as your company is flexible with makeup contributions is what it's called. I know Guardian is very flexible, and Mass Mutual, very flexible with makeup contributions. So let's say 30 grand times 7 years is 210,000 that the client was putting in 40K, 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 40K. So you have 210,000 of unused mech space. Let's say they 10x their income over a 7-year period, and they want to write a check for 200 grand right into their policy. They'll be able to do that because we created enough mech space to do so. And we set the base premium to allow that, because Guardian will allow you to put in 10x the base premium for as long as you have that term rider attached. As soon as that term rider drops, because we no longer need it, then it goes down to 3x the base premium. Does that make sense? Any questions around that?
Any questions around that? Okay. I have one question, and then I think we should consider wrapping up. I know we're all insurance geeks, and we could.
All right, we can talk about this all night. This gets me excited. Yeah.
Right. I'm loving the concept, and I'm currently working with one of my agents with a client. Earlier, you mentioned qualifying your prospects, and that's qualifying your clients. That is essential. And then I noticed you mentioned something that was out of the box thinking, where you wrote a policy on a 2-year-old. I'm currently working a strategy where I was counseled to put the life insurance on the parent, because that way the parent has access. The parent can go in and out to get the money for the child, and then they're still creating that death benefit that will be their legacy for the child. But if the parent developed a critical illness, then there you go. They have their money there for the critical illness rather than putting the policy on the 8-year-old. So I was just curious about the 2-year-old policy. That was out of the box for me.
Yeah, so with this particular case, like I said, this was a gentleman that was putting money into a college savings plan. And all he wanted to do was redirect that money. He was like, the college savings plan is only giving me maybe 2 to 4% or something like that.
Mm-hmm.
If I don't send my kid to college, I don't get those returns. I only get the principal. So he's like, you know what? Let me start a policy on my son now. And he already had a lot of death benefit because he works for the government. So he has a big term, I think. So 50% of that, we were able to put a whole life on his son.
Mm-hmm.
Enough said, right? So that was pretty simple.
That makes sense, because that's very, very important. Those
Yeah.
college 529s, if the kid decides he wants to be a musician and travel across the world, that money is gone.
Gone.
So
Yeah.
that's another point for us when we're talking to individuals out there.
It could only be used for educational. I mean,
education. Mm-hmm.
Not anything for where they're going to live when they get in school, the feeding. That's strictly education. If they don't go to school, that is money just costs.
Right.
How do you, how you doing, Denzel? Very, very good, powerful presentation. But how do someone transfer that 529 into, something like this?
So in that case, he kept the 529. He just stopped funding it. And then I have clients that will literally stop funding their 401ks. They'll stop funding their CDs, and they'll just redirect cash flow to their life insurance policy. Some people like to do that, or some people will just kill it. They'll take the money out, and they'll just roll over that money into a life insurance policy. I usually don't try to preach that or sell that, but some people just really get angry. They hate their 401k. They hate their financial advisor. They didn't teach them anything, and now they're getting the education for real this time, whether it's on my channel or other channels that they're watching, and they just get liberated. They feel great. Get that warm, fuzzy feeling, and it's a nice process.
Get and teach. That's key right there.
What
we're about is education. And when we educate our clients, they love us, they stay with us, they tell others about us because they're learning concepts that they've never heard of before.
Yeah. And I mean, like I said, this is complex. I'm still learning stuff to this day. There's so much. There's so much I don't know, obviously, about IUL because I haven't practiced it myself. But I was very curious and to just kind of start a dummy policy to just kind of see it. And if the agent tells me to convert it into a new IUL, that's an indication, that's a red flag that if I kept it the same, it'll become a mech. So that's the difference with a whole life. I don't have to change anything in my policy. It'll just keep working, keep getting my guarantees. I'm not trying to mix investing with savings. I like to kind of separate it. If I'm going to invest in the stock market, I'd rather do it right through my Robinhood account where I can avoid the fees that the insurance company charges me. Well, right, oh, TD Ameritrade doesn't cost anything. They've got 0 cost index funds that exist that do very well. So I don't have to pay anybody. You know, I open up my own brokerage account. So I try to teach people that, hey, you know, let's look at cost. What's the cost of me doing that or this?
Yeah. When you say qualify your client, I know you had mentioned getting their, say for instance, their tax return. You know, what type of things would we, you know, do to qualify the client other than, you know, having their tax return and just to try to put together something like this?
Let me share my screen real quick, and then I guess we'll close out with this being like the last question. And then, so where did I have it? Yeah, so qualifying. I look at the 4 major numbers is what I call it, and you'll hear me say this 100,000 times on my YouTube channel. Is the 4 major numbers of any individual is their income, expenses, debt, and cash flow on a monthly basis. Me personally, I like to see an individual with cash flow of $1,500 or more per month, and conservative. Like this is on the low end. They could cash flow higher. I like to see no debt or some debt, like a mortgage, you know. But if they have massive amount of, like, you know, they got 2 car loans, they got student loans, they got credit cards and a mortgage and a personal loan, a debt consolidate, you get a little crazy for me. So I'm like, okay, we got to work on the debt first. So 0 debt or some debt, like a mortgage, maybe 1 or 2 things. I like to see good income. What is good income? I like to see, like, you know, 5K or more. You know, the smaller incomes, obviously is going to be the smaller policy, unless they have this capital. I like to see capital. Do they save, right? How much money do they have in savings, right? Discipline. You know, so I literally interview the client because they already interviewed me on YouTube. They've already made a decision they want to work with me. Now I just got to interview them. So in many cases, I turn a ton of business away, or I refer my business to my agency because they do it all day long. They'll be more than happy to draw up illustrations and teach it. Me personally, I teach it on a bigger scale via YouTube videos, live streams, private Q&As. You know, I run through scenarios and things like that. And it's up to the client to do all that work and decide what they ultimately want to go with. But here are the kind of like the preliminary pregame work. You know, good credit helps too. I like to see, because when I work with a client, I understand that, you know, I'm working with these people for life. I'm 24. It's very likely that all of my clients are going to pass away before me, because most of my clients are double in their late 50s or 60s. So I want to have that really, really strong trust that if something were to happen to them, their kids know my name, husband or wife knows my name, whoever passed away, and they know who to reach out to make sure that policy gets delivered really fast, the death benefit gets paid out, because that can be a holdup too. Death benefit, you know, transfers and payouts, because they might, depending on how the person died, you know, or if husband never told wife he had a policy and it just sits there, you know, you can't get the money until you claim it. You know, the life insurance company is not going to know when the person dies until you put a claim in, you know. So giving them that whole entire process, I like to work with people through that whole way through. So if I have that good discipline already instilled, saves me a lot of time, right? And I think it's valuable as agents that we start creating more content, start recording, start, you know, create a series on, you know, how does someone go about finding an agent and all that good stuff. So that's it.